Over 40% of crypto investors have never filed a single tax return related to their digital assets. Not one. And the IRS knows exactly who they are. Welcome to BlockVault Daily. Today we are talking about something that most crypto content creators completely avoid, not because it is boring, but because it is genuinely complicated and the consequences of getting it wrong are severe. In the next 10 minutes, you are going to learn how crypto taxes actually work, what triggers a taxable event, and the one loophole that most investors accidentally miss every single year. We will also cover what happens when the IRS comes knocking, and why simply not knowing the rules is never a valid defense. Let us start with a little history. Before 2014, the IRS had virtually nothing on the books about cryptocurrency. Bitcoin existed. Ethereum was just being conceived. And most people in the crypto space treated digital assets like internet money that existed outside the traditional financial system. That fantasy ended on March 25, 2014, when the IRS released Notice 2014-21. That single document changed everything. It declared that cryptocurrency is property, not currency, for federal tax purposes. That distinction matters more than most people realize. When you sell property, you owe capital gains taxes. When you hold property, you do not. When you trade one property for another, you trigger a taxable event. That one classification set the legal foundation for every crypto tax rule that exists today. Fast forward to 2021. Congress passed the Infrastructure Investment and Jobs Act, which dramatically expanded reporting requirements for cryptocurrency brokers. Starting in 2023 and rolling out through 2024 and 2025, crypto exchanges are now required to report user transactions directly to the IRS using Form 1099-DA. This is not a rumor. This is law. The era of anonymous crypto gains quietly disappearing from your tax return is over. So what exactly counts as a taxable event? This is where most people get completely blindsided. Selling crypto for US dollars is the obvious one. But the list goes much further than that. Trading one cryptocurrency for another, for example swapping Ethereum for Solana, is a taxable event. Spending crypto to buy a product or service is a taxable event. Receiving crypto as payment for work is a taxable event. Earning staking rewards is a taxable event. Earning yield through DeFi protocols is a taxable event. Even some airdrops are taxable the moment they hit your wallet. Here is what nobody talks about. The people who lose the most money to crypto taxes are not the ones who made huge gains and refused to pay. They are the ones who made gains in 1 year, reinvested everything into another coin that then crashed, and still owed taxes on the original gain. You cannot pay your tax bill with losses that came after the taxable event. The IRS does not care that your portfolio is down 60% right now. If you made money on a trade in 2023, you owe taxes in 2023. Period. Now let us break down the actual tax rates, because this is where strategy becomes critical. Crypto gains fall into two categories, short-term and long-term. Short-term capital gains apply to any asset held for less than 1 year before selling or trading. These gains are taxed as ordinary income, which means depending on your bracket, you could be paying anywhere from 10% to 37%. Long-term capital gains apply to assets held for more than 1 year, and the rates drop dramatically to 0, 15, or 20% depending on your income level. This single distinction, 12 months versus 13 months, can literally save you tens of thousands of dollars on a significant gain. That is not tax advice, that is mathematics. What about losses? This is the part most people skip and it is worth real money. If your portfolio includes positions that are currently underwater, you can sell those assets to realize a loss and use that loss to offset your gains. This strategy is called tax loss harvesting, and in a volatile market like crypto, it is one of the most powerful tools available to an everyday investor. In 2022, when the entire market collapsed, investors who understood this strategy turned one of the worst years in crypto history into a legitimate tax advantage. You can offset up to $3,000 of ordinary income per year with capital losses, and carry forward any remaining losses into future tax years indefinitely. Let us talk about DeFi, because this is where things get genuinely complicated. Decentralized finance protocols introduce tax scenarios that even experienced accountants struggle to handle. When you provide liquidity to a pool on a platform like Uniswap or Curve, you are technically exchanging your tokens for liquidity pool tokens. that exchange may be a taxable event. When you earn fees from that pool, those fees are likely taxable as ordinary income at fair market value the moment they are received. When you remove your liquidity and receive your tokens back, there may be another taxable event based on how the token values have changed. And then there is impermanent loss, a uniquely defined phenomenon where the ratio of tokens you receive back from a liquidity pool differs from what you originally deposited due to price changes. The IRS has not issued specific guidance on impermanent loss yet, which leaves investors in a gray area that could easily go either direction when formal rules are eventually written. This is one of the most watched spaces in crypto tax law right now. NFTs are another layer of complexity. Purchasing an NFT with Ethereum means you have disposed of that Ethereum at its current fair market value, triggering a capital gain or loss. Selling an NFT for a profit means you owe capital gains tax on that profit. Creating and selling an NFT as a creator is typically treated as ordinary income. And if you thought the metaverse would stay off the IRS radar, think again. Virtual land purchases, in-game asset trading, and play-to-earn income have all been flagged for future regulatory guidance. But here is what nobody talks about when it comes to enforcement. The IRS has significantly upgraded its blockchain analytics capabilities. They have contracted firms like Chainalysis and Coinbase Analytics specifically to trace crypto transactions. Because all transactions on a public blockchain are permanent and visible, the IRS does not need you to self-report if they already have the data. And with new broker reporting requirements in place, the paper trail connecting your wallet to your identity is getting shorter every year. What does non-compliance actually look like in practice? In 2021, the IRS sent over 10,000 warning letters to crypto investors suspected of underreporting. Some received CP 2000 notices for mismatched income. Others were audited. In the most serious cases involving intentional evasion, criminal charges are on the table. The penalty for failing to file or pay can reach 25% of the unpaid tax amount, and that is before interest compounds on top of it. The smartest thing any crypto investor can do right now is get their records in order. Every trade, every swap, every staking reward, every airdrop, every NFT purchase and sale. Tools like Coinly, CoinTracker, and TaxBit are specifically built to import transaction data from wallets and exchanges and generate the tax reports you need. Many of them integrate directly with TurboTax and professional tax software. These tools are not a luxury. They are a necessity if you have done more than a handful of transactions. For investors with complex situations involving multiple chains, DeFi positions, and significant transaction volume, working with a CPA who specializes in cryptocurrency taxes is genuinely worth the cost. The crypto tax space is specialized enough that a general accountant may miss deductions or make costly errors. Finding someone who understands the nuances of on-chain activity versus exchange-reported income is a real competitive advantage. Here is the bottom line. Crypto is one of the most powerful wealth-building tools of the modern era. But it does not exist outside the law. The rules are complex, they are evolving fast, and the IRS is more equipped to enforce them than at any point in history. Understanding your obligations is not just about staying legal. It is about making smarter decisions, preserving more of your gains, and building long-term wealth with your eyes open. Keep your records clean. Know your holding periods. Use your losses strategically. And if you are in doubt, talk to a professional. This video is for educational purposes only. Cryptocurrency investments are highly volatile. Never invest more than you can afford to lose. Before you go, if you learned something new today, hit that like button right now. It genuinely helps this channel grow. Subscribe to BlockVault Daily for a new video every single day. We will see you in the next one.